I promise when you guys get to the point where you know what you're doing and you leave social media, you turn it off, your trading is going to go through the roof. Your performance is going to be astounding. You're not going to care how you measure up to somebody else. And you're not going to worry about what they're doing, how bad they hurt themselves, or how much money they made, or what their payout is, or where they're at on the FTMO leaderboard. All those things are there to cause you to do more of what is likely to incur failure. The statistics are there. 90% of people fail doing this. So if you entice them to do it more frequently with larger leverage than they should, you can trade with 15 contracts with your funded account challenge. Well, guess what? That is a recipe for them to get another reset fee from you. And my son went through that. Oh, it's only $100 and some or whatever it is. I'll get it. I'm going to prove dad wrong. Okay. Well done. You paid them. You made nothing. So he has to go back to square one. What's square one? Waiting for specific times of the day. So let's look at the London session. Now, as far as indices, I haven't talked too much about indices, but we'll be doing that. And I actually got some live sessions we'll do during the London hours. What's that? I got to call out of work. I can't miss that ICT. There you go. Anticipation. You can't react to it. So London, by characteristic, what I'm referring to is, we always refer to things in New York local time. So whatever the time is in New York, you need to have a clock set at your trading desk that is always showing you New York local time. I don't care where you live in the world. Everything algorithmically is running on New York time. I don't care who tells you otherwise. I don't care. Okay. This is the way it is. Just submit to it. So when I talk about specific times of the day, it's always on the basis of New York. Okay. So London time between 2 o'clock in the morning, New York local time, to 5 a.m. New York local time. That's a 3-hour window. And the sweet spot is between 2 o'clock and 4 o'clock. So those 2 hours, but it can extend to 5 a.m. Generally, you're going to get some kind of false breakout. Okay. And that's not earth shattering. There's always been some idea of expectation of anticipating some false breakout in London. That's just the natural characteristic to it. What you need to be concerned about is where we are coming from on the hard time frame, weekly and daily chart. If you're trading in London, if you're not referring to the weekly and daily for your setup, you're trading blind. You have to look at what that weekly, what's the importance of the weekly chart, Michael? Well, I talk about how you can anticipate, not react, anticipate where that weekly chart candle that's forming, or that will form tomorrow when it starts on Sunday at 6 p.m. when all trading begins. Now we're starting a new weekly candle. So you want to anticipate the likelihood of that weekly candle expanding up or expanding down. And you're looking for an inefficiency or stops that's most likely going to be the draw. It doesn't mean you're going to be right. Sometimes I get it wrong. It's okay. You're going to, especially with the climate right now, we don't know what war is going to break out. We don't know if the bank's going to close over here. We don't know if, the Fed's going to do that. There's so many things that are compounding the difficulty right now. And anybody that tells you it's easy, they're lying to you. They're just championing their getting lucky sessions at the time. And they're probably not showing you all the times that they're losing. But you have to factor in what that weekly chart is doing, likely to do. And that starts your bias, bullish or bearish. And on the daily chart, you have to confer with the previous day's range. Now, let's assume for a moment that the weekly chart, you think that there's going to be an expansion lower on whatever market you're trading. Now, this is both forex and index futures and commodities. Okay, so it's not, unless I say, here's another general rule of thumb. Unless you hear me say this only works for this, which is very, very, very rare, everything I'm teaching you works on forex, and it works on futures, index futures, and commodities. Okay. I don't know about crypto. I don't have any affinity for it, so I'm just gonna let you discover it for yourself. If it works, great. If it doesn't, I don't care. I don't care either way, because I'm not going to be trading any of that. So London, you're going to look at the previous day's range, and let's assume that you're looking for lower prices. You think that that weekly candle is going to expand lower, and you want to look at yesterday's daily range. And it does not matter if yesterday's daily range is up close or down close. There's more advantage if the candlestick from yesterday is up close, because you want to see a move that breaks below that yesterday's low. Once it does that, that lower 0.25% or lower third of that daily range, if you are in fact correct about your analysis and it's going to go lower based on the weekly chart, your sell setup is going to form in the lower quarter or lower third of the previous day's range. Now, by itself, that's not earth shattering, but I'm going to tell you something right now. If you chase price action and you always get burned, go back and look at your losing trades and you'll see that's exactly what you didn't see. So it has to refer back to a previous portion of the previous day's range. And this is not new. This is all in my core content. I teach this in core content. But because there's so much content and you breeze through them too quick, like Netflix and chill, you're binge watching. And it's so much information. You have to watch these videos multiple times, because you're not gonna have an appreciation for what I'm talking about, because you haven't encountered it yet in price. And then when you start looking at it conceptually and then looking for it in old moves, then it's impactful. Then it has much more meaning to you. And then you'll learn more about using it and how it will groom you into a better analyst. You can't be a good trader without becoming first a good analyst. And so many of you just want to be a rock star trader and not know how to read markets. And it never works. That never works. That's why you get these flash in the pan, winners, but you can't hold on to them. You're like a gunslinger that just picked up a gun for the first time, and you got lucky. And now when it comes time to do a duel with someone who has lived their life as a gunslinger, you get gunned down. And if you have the breath in you long enough to think about what you did, you'd be admitting, I wasn't ready for this. So in London, you're looking for false breakouts. Okay. And you want to see, now this is where you write stuff down, folks. You want to see some measure of a 15-minute or 5-minute relative equal highs inside of the range that would be in the lower third or 1/4 of the previous day's range when you're bearish. Now, some of you are like, why don't you just do this on a video? Can you just show me? Can you just listen? Because I'm explaining it to you. This is how you learn how to do it. You go into your charts looking for it. And when you find it and you do examples of logging that and having dozens of them as examples, then it's more meaningful because you found them using these rules. Whereas if I just show you a chart, oh, okay, well, it doesn't mean anything to you. You didn't do any work to look for it. But when you see it and you study how it reacted in price after that, okay, we're anticipating that future reaction by price. We aren't reacting to price. We're anticipating price to do these specific things, which is what? If we're bearish in London, you want to look for a single high or a relatively equal highs inside of the previous day's lower 1/3 or 1/4 part of the daily range of yesterday, whatever the yesterday is. If it's a Monday, it's Friday's daily range. Otherwise, it's whatever the previous trading day is. That's pretty simple rules, right, folks? So in between 2 o'clock and 4 o'clock, we would anticipate a rally above those relative equal highs on a 5 or 15-minute chart, whichever one's easier for you to see. Regardless, you'll see it. If you want to use a 15-minute chart as a bellwether, I use that as mine. But you can look at it on a 5-minute basis. And as it rallies above that, what's going to be resting above those relative equal highs or single high? Buy stops. And the characteristic for the London session is to run up and entice traders to chase it going long. When in fact, it's a function of running into buy-side liquidity for smart money to absorb those buy stops and be counterparty as they flood the market with buy orders. Shorts are entered by smart money there because it's a run on liquidity. It's engineered to provide a entry mechanism for smart money to go short. It takes a lot of confidence to take that type of trade because usually in London, the Judas swings are very violent and they're quick. And it feels like it's going to go up 100 pips. It's going to go up, 80 handles on the S&P. Look at this thing move, man. Wow, it's going up 12 handles. Look how fast it's moved. This thing's going to keep on going. If you feel that way, you're reacting to price. When we're looking for that to be a run real quick to get to those stops so that stops can't be pulled. And once that happens and the orders are not pulled by the traders that have those orders resting there, we anticipate price rejecting there and going lower. Now, if you can't take that type of trade or entry in the beginning, you won't. Let's just be fair. I say this all the time. Buying sell stops and selling short buy stops is one of the hardest things to do as a trader, because at the time when it happens, it's fast, it's furious, and it's scary. And you have to know what you're looking for, which is why you have to anticipate and predict the future. You have to. Profitable trading is predicting the future, folks. I don't know why you want to argue with that, but that's what it is. Reacting to price. Okay, you reacted to what it did and you entered into a trade. Now what? You just let whatever the wind carry you in the current without a rudder. You just, whatever happens, man. Stuff's all random. If that's how trading really is, to hell with that. I'm never going to do it. I would never do that. Anybody in their right mind that would go into a venture like that, risking money, saying, well, you just got to see what happens. You know what that did for you when you start your demo trades, right? You get out there, let me just push the button. I'm bored. Let me see if I can make $5,000 in 10 minutes. And you lose. So you know that mentality, what it does for you. And it's not going to change with real money. Let me see what happens if I push the trade on. Boop, there it is. I got funded. I got through the portion of where we pass it. Now let me see if I can just make one of those real quick 5-figure withdrawals, because if I get one of them, that'll be enough to carry me through, even knowing that I don't know how to trade. And you wrestle with all that stuff because you're trying to do stuff that you're not prepared to do. You don't know how to anticipate. You're reacting, but you call it anticipation. You may share it with the community and me that you found a trade, but you're probably not being honest about what you felt the entire time you did it. It was just that one that panned out for you. So I'm not trying to encourage that type of thing in our community or in any of my students. You need to be 100% honest. And if you're struggling, find out what you're struggling on. But having a time-based approach helps you identify where your problem areas are. If you're not trying to trade at a very specific time of the day, how are you going to be able to measure your progress? How could I fix your issues for you if I was to sit down with you? I'm not making this invitation for you folks. I'm just saying, if you were granted the opportunity to sit down with me one-on-one, side by side, right next to each other, and say, okay, Ict, here's my problem here. I'm doing this. I took a trade in London and this, that, and other thing. And then I saw this trade in New York and I was doing this and doing that. And then, I made some money there and I was like, I want to go into the afternoon session. I'm going to trade the last hour in S&P. And then I lost everything. What am I doing wrong? Number one, you're overtrading. 2, you're not being a specialist. You have to be a specialist in terms of what market you're going to trade and what time of day you're going to trade. See, in your mind, you're thinking, wow, I can trade the London session. I can trade the New York Open session. I can trade the lunch hour when they run on stops. And then I could do the PM session. And I got the 2 silver bullets in the AM session, the PM session. Good grief, I can do this. And all of a sudden you're you're top of the leaderboard of FTMO and you're winning the Robbins Cup and you're blowing everybody else away on social media. And I get it. I know that's what everybody wants to do. But you can't do that. You're learning all of this at your own pace. And some of you, if not all of you, are not providing the permission that you yourself require of yourself to take whatever time is necessary for you to learn how to do this. Books, authors, teachers, mentors, courses, products, none of that is going to remove the impact that you yourself bring to this. The learning curve is going to be whatever it is for you, however long it is, because of who you are and what you wrestle with. And pretending that you don't have any of these problems that I talk about and other traders may refer to is nonsense, because there is no perfect student of the market that came in with no baggage or no mental barriers. Everybody has their own things. And some of them may not be a point of which where you overcome them. And it might not be feasible for you to do this. And then you would have to submit yourself to someone that does it really well, and you buy their signals or setups or their product. And in that case, I don't think that's wrong. I don't, if someone can prove that they have something that works, or they have a signal service that does well, and you can't do it yourself, I don't think there's any shame in that at all. There's no shame in that, because it's difficult, folks. You're the deciding factor in whether you're going to succeed or not. It's not the thing that you're using. It's you. It's you and what you are willing to do and what you're not willing to do. So in London, you're looking for false breakouts and runs above relative equal highs when you're bearish, or a single high that is inside of the previous day's range. Now, I know there's no chart here, but I want you to think about conceptually. Let's look at it like this. If you have note-taking instruments in front of you, this should be an easy thing for you to do. Let's just say, hypothetically, you draw a rectangle, leaving room for a rectangle to the right of it, okay? So you're going to draw a rectangle, and at the top of that rectangle, you're going to say 100 is the high, and the low is 20. So you have a previous range of 80 units. It could be pips, it could be points, it could be whatever. But we're going to say it's 80 units. Then you're going to see where you open up at 2 o'clock in the morning, New York local time. Wait a minute. What do you mean open up, ICT? Wait. Look, you just said, and I understand that the market starts trading at 6 o'clock. What are you talking about opening at 2 o'clock? Yeah, now we have a new opening range. 2 o'clock's opening price. What is that? The first opening price on the first 1 minute candlestick at 2 o'clock, New York local time. You want to note that. Now that's an important price point. From that price point, you want to see it be, if you're bearish, you want to see it be below the 20 level of the previous day's range, because that's what that rectangle would represent. And that's, for example, let's just say at 2 o'clock on the trading day that you're in right now, say it's 18 in reference to the previous day's range. So now you're below the low of yesterday's daily range. So from 6 o'clock all the way now to 2 o'clock in the morning, the market has done whatever it's done. If those highs, that relatively equal high or a single high in the previous range between 20 and 80, if there's a single high or relative equal highs in that lower 1/3 or quarter point of that previous rectangle that you're drawing out, that represents the previous day's trading, you're anticipating at 2 o'clock in the morning, on the trading day that you're watching price at right now, you want to see a Judas swing shoot up. You're going to anticipate that. You're not going to react to it. You're waiting for it. You want to see that very thing happen. Now, as an ultra short-term scalper, you can buy that, but you have to be very nimble, because it can go up there and turn on a dime quickly, because London is a false breakout characteristic time period. When it runs up there, why are we anticipating a run back into the previous day's range, but only the lower quarter or 1/3% of the range? Because we don't think that the previous day's high is going to be taken out. And we don't think that half of the previous day's range is going to be a factor at all. The best shorts are going to occur in the lower half of the previous day's range when bearish. What did you just say?